Hello and welcome to my review of corporate governance in the United Kingdom. There have been significant major changes in corporate governance requirements between September 2018 and January 2019, which will affect both the behaviour and the reporting of companies during their financial years, starting on the 1st of January 2019. So I've prepared this review. It's a bit technical, just so that you are aware of what is going on. I recommend that if any of these things do apply to companies that you're involved with, that you get hold of the regulations, etc. And I do give you the links for that. So let's get on with the presentation. Okay, so corporate governance in the United Kingdom by me, Richard Winfield. Let's get on to this. So as I was saying, the UK Corporate Governance Code application and reporting requirements have been expanded to include companies listed on the alternative investment market, AIM, and also large private companies. So more companies, different companies, must now take formal note of the rules and regulations and the processes associated with corporate governance. I would assume that all companies will have good corporate governance practices anyway, but now it has to be reported. In 2018, 3 new corporate governance codes were introduced. The UK Corporate Governance Code, which has been around for many years, has been revised significantly. The Quoted Companies Alliance Corporate Governance Code has also been reviewed. And then there is a new corporate governance code that we refer to later, the Waits Principles. The UK Corporate Governance Code, July 2018, the revised version. This code is applicable to all companies with a premium listing in the UK or elsewhere for accounting periods beginning on or after the 1st of January 2019. So it's a different code in detail, but the basic application is as before. For parent companies with a premium listing, the board should ensure that there is adequate cooperation within the group to enable it to discharge its governance responsibilities under the code effectively. Now for AIM companies, under the revised AIM Rule 26, AIM-listed companies must now follow and report on a recognised corporate governance code. Companies must disclose on their website the details of the corporate governance code that has been applied, and it doesn't define which one has to be applied, how the company complies with that code, and any instances where it departs from its chosen corporate governance code. The AIM regulation expects disclosures to be reviewed annually and for details to be provided on the date the disclosures were reviewed. The regulation also expects that information on disclosures will be clearly presented and easily accessible from the AIM Rule 26 landing page. The London Stock Exchange highlights benchmark codes, which include the UK Corporate Governance Code and the Quoted Companies Alliance Corporate Governance Code. So these are ones which are formally approved by the London Stock Exchange. You are not required as an AIM company to use one of these. It's up to you to choose and to defend your choice. But these two we know are formally approved. The QCA Corporate Governance Code is a pragmatic and practical corporate governance tool designed for quoted small and medium-sized enterprises in the UK. It has been around, it's recently been revised. It is a standard setter, not a regulator. Now, for large private companies who were not covered before must now state which corporate governance code, if any, has been applied and how it's been applied. The Waits Corporate Governance Principles for Large Private Companies is the title of a new document which was produced in December 2018 and is available from Financial Reporting Council, and it is designed specifically for large private companies. The Waits Principles introduce an approach to good corporate governance that offers sufficient flexibility for a diverse range of companies to explain the application and relevance of their corporate governance arrangements without being unduly prescriptive. Now, it's all tied up under the corporate governance reporting regulations. Now, these are quite detailed, and it's not for me to be able to get that over to you now, other than to make you aware of where they might be relevant. And I do give you the contact at the end of this presentation. So the company's miscellaneous reporting regulations 2018, that's what it's in. And if it's relevant, you surely should download a copy and study it carefully, probably with a highlighter. The introduction of new corporate governance codes and regulations have expanded the requirement for UK companies to adopt formal governance practices and to report on their behaviour, as I've been saying. In order to be able to interpret and apply the regulations, it's first necessary to understand the definition of company types. And I found this a little complicated myself, so I have made some notes. If you are covered by one of the definitions, then clearly you need to be able to follow that up under the regulations. So a small company, which is probably not covered by most things, but it is covered by some. A small company has an annual turnover of less than £10.2 million. The balance sheet total must be not more than £5.1 million, and the average number of employees must be not more than 50. Now, for a medium company must meet at least 2 out of these 3 criteria. Annual turnover must be not more than must not be more than £36 million. The balance sheet total must be not more than £18 million, and the average number of employees must be not more than 250. So it needs to meet 2 out of those 3 criteria. A quoted company. A quoted company, as far as these regulations are concerned, is any UK incorporated company that is quoted on the official UK official list, on the New York Stock Exchange, on NASDAQ, or a recognized stock exchange in the European Economic Area. It does not include companies listed on the Alternative Investment Market, AIM. That's for the sake of these regulations. There is requirements to apply to a company reporting on financial years starting on or after the 1st of January 2019. So they're relevant to you now, but they won't become apparent till sometime after January 2020. So all quoted companies, however large or small, if you're a quoted company, the following applies. All quoted companies must illustrate in the director's remuneration policy within their director's remuneration report the effect of future share price increases on executive pay outcomes. They must summarize any discretion that has been exercised on executive remuneration outcomes reported in respect of share price appreciation or depreciation during the relevant performance periods. The requirement to illustrate the impact of share increases on executive pay outcomes applies to any new remuneration policies brought forward by companies from the 1st of January 2019. And my understanding is that that needs to be reported when it comes into effect, not in the accounts for the following year, or not for the accounts during the following year. So companies with more than 250 UK employees. They must summarize how the directors have engaged with employees. This is an important new development and has led to quite a lot of discussion and challenge. They must summarize how they have had regard to employee interests and the effect of that regard. And they must also summarize any principal decisions that have been taken in the financial year with regard to employee engagement. Now, for quoted companies with more than 250 UK employees, they must show, and I'll read this out and then I'll explain it, the ratio of the CEO's total remuneration to the median 25th and 75th percentile full-time equivalent remuneration of their UK employees. This short, simple sentence means they must identify the salary at which 25% of the staff are earning less than, or 50%, the median, are earning less than, or 75% are earning less than, and they must then compare that with the total remuneration of the chief executive. There must be an explanation of consistency with the company's wider policies on employee pay, reward, and progression. So in other words, they've just provided the facts. Now they must explain how that fits in with the policies and practices. Now, for large companies, and remember we had a definition for large companies earlier on, large companies must include a statement as part of their strategic report describing how the directors have had regard to matters in section 1721, subsections A to F, of the Companies Act 2006. And in terms of the latest interpretation of the Companies Act, there is a separate video and a previous webinar. Now, these are new, very large private and public unlisted companies. They must state which corporate governance code they have adopted. They must explain any departures, and if they haven't applied a formal code, then they must explain what corporate governance they have applied. So that's it. If you were affected by any of that, I strongly suggest that you download the Company's Miscellaneous Reporting Regulations 2018, and also a summary of the regulations, which is under the heading of question and answer, from the UK government website, which is legislation.gov.uk. It's all there, but it's quite detailed. And finally, the QCA, the Quoted Companies Alliance Corporate Governance Code, is available from theqca.com, but it's £85 plus VAT, unless you're a member. And it's the only thing of all the corporate governance stuff that I've dealt with that I've ever had to pay for. But £85, if it affects you, it's really important that you purchase. So that's it. It's fairly simple, fairly straightforward, but it's actually quite important to recognize that the net for corporate governance code practice and process, and also specifically for reporting, has been significantly broadened and enlarged in recent months. So I hope you'll find it useful, and there will be a replay available if you need to go back and study some of this again. So thank you for watching, and I look forward to talking to you next time. Thank you.